Right. The purpose of this video is to show you how to do Unit 1, Activity 5, Adjusting Entries Part 1, the assignment part. What we'll do first is take a look at the assignment page here, and then I'll just kind of walk you through what you need to do here. So the first link is going to open up the actual assignment. So I have that opened in a tab here. And so this assignment has kind of all the facts you need for the assignment. And then if you go back to the assignment page, you're also going to see this link, which is a template for the journal. And so this is what we will be completing the assignment in. So when you click on that, it's going to bring up a Excel spreadsheet that is just a blank journal. Accounting journal. So you'll need those two things in order to do this assignment. So what I'm going to do is I'm going to click over to the assignment and we can take a look at what is required. And then we can start figuring out what needs to go in that journal page. So adjusting entries, since this is grade 12 accounting, you would have seen this in grade 11. But in my opinion, it's one of the more confusing lessons and confusing kind of concepts in grade 11 accounting. So it's likely that, maybe you're a little confused on this one. So hence the video. So in the top part, it gives a description of the business that we are doing this journal for, and it's a landscaping and snow removal company. And so we are going to be preparing a journal entry, or 5 journal entries to be exact, for December 31st, 2014. So basically the end of the year. And so adjusting entries comes at the end of the year because there are things on your books that need to be adjusted or changed because the numbers aren't accurate or don't accurately portray what happened with the business that year. And so we can get into what that means a little bit more as we're doing it. But that's the basic idea of adjusting entries. You have numbers on your books and they haven't been corrected or changed or adjusted according to what's gone on in the business throughout the year or throughout the time period that you're adjusting for. And so you need to go back and make those changes or those adjustments. In the middle, we've got a list of accounts for this business. So all the different accounts that exist within this business and within its books. This is very valuable to us because sometimes when you're putting together these journal entries, you don't exactly know, or it's not top of mind what accounts are going to be affected by these transactions. So it's really nice to have that list to look at and kind of have as reference. So to see what you mean when we look through these transactions, or see what I mean, I should say. And then down at the bottom, we've got our 5 adjustments that need to be made, or 5 transactions adjustments that need to be made. In this video, I'm going to do the first 2 because there's only 2 styles of adjustment in this assignment. And so those first 2 represent both styles, or one represents one style and the other represents the other. And then 3, 4, and 5 are just like variations of those first 2, just with different numbers and like different accounts, but it's the same concept in those. So once we've done 1 and 2, hopefully you could do 3, 4, and 5 on your own. So that's what we'll do here. All right. So the first one we'll look at is transaction number 1. And so it says, on July 1st, 2014, a customer signed a contract and agreed to pay $840 for 12 months of landscaping and snow removal services. All right. So basically, a customer said to us, hey, I'd like you to do my landscaping, and I'd like you to remove the snow in the winter, for my driveways or whatever. I don't want to pay you every month because I don't want to keep track of that. So what I'm going to do is I'm just going to pay you guys $840 right now, and then you can, deduct that, or you can, and that'll pay for your services for the next 12 months, right? And so you go, okay, great. So you give me the $840 now, and then I'll come and do the stuff for you, and we'll all be happy. which is perfect. But from our business's perspective, this Mason landscaping and snow removal service, we need to keep track of that money that we took from our client, so that we know where it came from, and so that we know how much of it we've actually earned, and then how much of it is sort of sitting, I guess the term is maybe an escrow, meaning we haven't really earned it yet, but we do have possession of that money. We want to keep that separate, or we want to keep that separate in our books, so we know how much money they gave us, how much of it we've earned, and how much of it we still have left to earn, right? So that's important, because, obviously if you had one customer, it might be easy to keep that stuff in your mind and keep it, like memorize it. But if you've got several customers, 100 customers, there's no way you're going to remember all that. So that's where the accounting comes in. Okay, so the question is, what kind of adjustment is this then? There are several different styles of adjustment. And so this one is, if we go to our second page of our content section, you're going to see kind of a write-up about unearned revenues. And so this is an unearned revenue style of adjustment. And this is very worthwhile reading if you haven't read it yet. And if you were confused by this assignment, this gives you kind of a reasoning of, or an explanation of what unearned revenues is, and then also kind of walks you through what calculations are necessary to make this kind of adjustment. I'm going to kind of go through it here with you, but if it still doesn't make sense, then I would absolutely recommend reading through this. So anyway, this is the second content page, like I said, in Unit 1, Activity 5. And so you can read through this yourself. And as you see, like I said, they show you the calculations that are necessary, which might be helpful. And then also there's a video here, which is very good. And this one will help you as well. It's another YouTube video, another professor who might explain it a different way than I am, that might click for you. So if what I'm doing here doesn't help you, check out that other video. All right, so like I said, this is an unearned revenue adjustment. So basically what we need to do here is look at the amount that was given to us at the start, which is that $840. How much that is, or how long that is meant to last us, or how long it is meant to pay for our services. And so that's 12 months. Okay. So the first calculation we want to do is, how much are we getting paid each month by this customer? Okay. So in order to do that, we just take the amount that they paid us and we divide it by the number of months that that amount is supposed to cover. So get my calculator out here, and we'll do 840 divided by 12. So every month they're paying us $70 for our landscaping services and for our snow removal services. Okay, great. So now we know how much we're getting paid each month. Now the question is, we're sitting here at the end of December, right? It told us that at the beginning of the assignment. We're sitting here at the end of December, and we're trying to get our books in order and make sure that everything's square. So we got to figure out how much of that $840 that the customer gave us have we earned up until now. All right. And so they gave us that $840 on July 1st, and now it's December 31st. So if we count, we can figure out how many months we've been providing service for them and see how much of that money we've earned so far. So we worked for them in July, September, October, November, and December, right? So July, September, October, November, December, 5 months. And am I messing that up? I thought it was supposed to be 6 months. It's the end of the day here, guys. If I'm messing that up, let me know. Or if I'm skipping a month or something, it's supposed to be 6 months. So we're supposed to have used up 6 months of this. So we're going to multiply our monthly rate by the 6 months that we've worked for this customer so far. So our $70, we're going to multiply it by 6. That's the 6 months that we've worked so far for this money. and that's $420. All right, so we have earned $420 of our 840. Okay, so we've got the number that we're going to put into the journal. We've earned $420. Now, what accounts are going to be affected by this is the question. And so for the unearned service style of adjustments, there should be an unearned service fees account and then a service fees earned account. And so if we look at our list of accounts here, you'll see that we do have the unearned service fees account, and you'll see that we also have the service fees earned account, right? And so the question is, how do we put this into the journal then? So let me open up my Excel page. For the date, this is going to be December 31st, and that's going to be true for all of our transactions here because we're doing all of these adjustments on the same day, December 31st. So we can put that in like that. And then we're going to have our two accounts that are affected. So we've got our unearned service fees account. And then we've also got our earned service fees. Okay. And then we've got our number, the $420. All right, and so remember that when we're adding into the journal that we always want our debit to go first. It just so happens that I properly put that in. Our debit account is going to be our unearned service fees, and that's going to be $420. And then our credit is going to be the earned service fees, so the 420 goes out with credit. Now, the way to think about this is that you're taking money from one account on your books and putting it into another. So basically, we are taking the $420 out of the unearned service fees, which would have originally had all $840 in it. And then we're taking the money that we've earned and putting it into our earned service fees account. These are both under the revenue section. The earned service fee is a revenue account. And then the unearned service fees is a contra account, I believe. So it's like nested under the unearned or the earned service fees. So when you take something out of a revenue account, it's a debit, and when you add to a revenue account or make a revenue account increase, it's a credit. So you'll see that's what's happening here in our journal entry. We're taking money out of a revenue account, the unearned service fees, and we're putting it into our earned service fees account. So that's a credit. When you add to a revenue account, it goes up, it's a credit. Right, and then the third line there would just be a description of what this transaction is. So I'm going to put in to adjust for unearned actually, I'm going to say earned service fees. So to adjust for earned service fees. So basically to move money from our unearned account to our earned account. Basically keeping track of how much of the money that we are holding from our client that we've actually done our services for. And you'll see that a couple of formatting things were already done for me, and that's just because I have done this assignment before in this particular journal page. So the description of what went on in this transaction on that third line was already italicized, which is supposed to be, but when you're doing it, it probably won't be. So you just got to hit that italics button. And then the other one that was already done that wouldn't be done for you and yours is I've got a indent here in front of the earned service fees account, which is proper to do because it's a credit. But in order to toggle that, You got these two buttons up here with the little arrow and the indent button. You can toggle that back and forth, but we want it indented like it was, so we'll leave that. All right, and so that is the first adjustment or the first transaction finished, and we got that done. And so, like I said, the other one that is also an unearned service fee or unearned service adjustment is number 5. So when you get to that, you can kind of try to follow the same process that we did on number 1. Next one we're going to do is number 2. And this is a different style of adjustment. So like I just did for that other one, I'll try to take you through it and explain what the process is for it. Okay, so the balance in the supplies account at the end of the year is $1,200. A physical count of the supplies shows that there is $300 worth of supplies as of December 31st. Okay, so to break down what's being said here, basically when you run a business, you got to have supplies in order to do so. For a landscaping company, I'm trying to think of what supplies would be. I don't know, I guess gardening tools and things like that. And I guess for a snowplow company, I don't know, a map. I don't know, but whatever you need in order to run this company. When I think of supplies, I think of like, you know, in the business world, you got a supply cabinet full like paper and pencils and pens and tape and whiteout and all sorts of file folders, all sorts of stuff like that. So anyway, at the beginning of the year, or the beginning of the month or whatever, you stock up on stuff, and then you let people throughout the year take out whatever they need and use it. And then you get to the end of the year and you see how much you have left. So that's what's going on in this one. So we started the year with $1,200 worth of supplies. And then when we went in on December 31st, we found out, okay, we've only got $300 worth of supplies left. So our first calculation here is, well, what's the difference between those two numbers? How much or how many supplies or how much supplies have we used up over this year in a dollar amount? So all you got to do is subtract 300 from that 1,200 to figure out how much has been used up. I'm sure you guys can do this in your head, but I'll just do it for our benefit here on the calculator. So that comes out to $900 worth of supplies that have been used up. Okay, so that's a fairly easy calculation. And now, of course, the question is, well, what do we do with that $900 figure, right? And so this is where, if you go to content page number 1, you're going to see this prepaid expense supplies scenario laid out here. So you can check this out as well. And then they also do it prepaid expense for insurance here, which will be helpful on transaction number 4, but also for transaction number 3. It's basically the same thing. It's just they're talking about rent in that one and insurance in that one. So anyway, not to get too sidetracked, but if you're more of a visual person, you like to read these explanations, or if that kind of thing makes more sense to you, this is covered on the content section. So if you haven't checked that out, go ahead and check it out. And again, there's a good video there too, professor guy who might have a better explanation than me. So if what I'm doing here is not helpful, check that out. All right, so we've got our number. We got that $900 that we calculated, $900 worth of supplies that have been used up this year. And now we just got to figure out how to put that onto our journal. So let's look at our list of accounts and see what 2 lists or 2 accounts do we think might be affected by this. And of course, you want to look for key terms. So our key term in this one is supplies. So if we look through our list, we're going to see supplies. So we got a supplies account. A supplies account would be an asset account. It's something that the business owns and has spent money on and kind of goes towards our worth. And then we've got another account that has supplies in it, which is the supplies expense account. So this is where we keep track of how much we've spent on supplies over whatever the given period is. In this case, it's for the year. So we have a supplies expense account. And that one shows up on the revenue portion of our our income statement, but the revenue, I guess, part of our balance sheet, if you want to think of it like that. All right, and so then we will put those two accounts on our journal and then figure out which one's the debit, which one's the credit, and then put our $900 amount there and then move on. So we'll put the 31st there. It's understood that this is December already, so we won't have to redo the December. And then we'll put in our two accounts. So expense accounts, basically anytime you're adding to them, and in this case, we will be adding to our expense accounts, basically meaning we're keeping track of all the expenses that we've had, or the money that we've spent on a certain item, in this case, supplies. So we're adding to the amount that's been spent on that. And so when you do that to an expense account, which is any expense account, it's a debit. So supplies expense is our first account, and it's going to be our debit. And we're going to do the $900 there, the $900 that have been spent on supplies over the year. And then our second one is going to be just the regular supplies account, the asset account. All right. And so again, that one's indented, so that's done properly. And then we just want to put the 900 in the credit side. And that's a credit, not only because the other one's a debit and you have to have them balanced, but as we talked about, a supplies account is an asset account. And anytime you are deducting from or decreasing an asset account, it's a credit. So we, in this case, have deducted our supplies over the year by $900, or we've lost $900 worth of value in our supplies account. So we need to take that out of there so that we don't think that we have more supplies than we do. Right. So we got to back that 900 out of there and then record it in our supplies expense account, as we did in that first part of the journal entry. And then the last thing to do is to do a little explanation of what we did here. So to record supplies used for the year. All right, and again, that is italicized so that we can separate the explanation from everything else, and it just makes it easier to read. All right, so that is the second adjustment. Like I said, I'm going to leave it there because the other three adjustments in the assignment are similar. They just have different numbers. So 3 and 4, as I said, these you will find how to do or be reminded how to do in the page 1 of the content page. If you follow these kind of directions, you'll be in good shape. They're also very similar to the supplies one we just did. They just deal with prepaid insurance and prepaid rent instead of supplies, but the same principle is involved. And then the last one, as I said before, this one is like the first one that we did. So the unearned revenues style of adjustment. All right, so hopefully you will have success working on those. And those will just go below the 2 that we just did. All right, so hopefully that was helpful. If not, let me know in class and we can talk about it. Otherwise, have a good one, and I will see you next time.